Welcome to earnings season Q2 2025. I'm going to show you how I entered a few spreads and made an 11% return with a 100% success rate. My software went out and scanned the universe of stocks and came up with some recommendations. I went ahead and took some of those recommendations on stocks that I like and stocks that I was willing to own, and I thought they had a good chance of being successful. Let's jump right in. All right, so last week, my software went out and scanned the universe and looked at several stocks and then came up with some recommendations where implied volatility was high. When the market opened up Monday morning, I looked at a few of these, and this was what the software was recommending on these strike prices, but I may have entered something a little bit different based on where it opened. I used implied volatility to determine what my strike price was. I'll show you that here in a little bit. And I set it up as all put spreads. So rather than entering a naked put on each one of these, or the stocks that I'm going to enter into, I entered it as a put spread so that my risk was capped, and I gave up some of my premium, my upfront premium, to buy insurance on the downside. So the stocks that I ended up entering were ASML, I entered Netflix, GE, Chipotle, and Royal. Those are the stocks that I entered my spread. And when I gave up some of my premium for the naked side, I bought insurance on the downside, but I collected $65 of premium. Now, I only had to use $500. That's a pretty decent return on $500. Here's one. Netflix. I made $109 and used only $1,000, so a little over a 10% return. So each one of these, you can see that I'm trying to get over a 10%. This one's a little bit under 10%, Chipotle, but I felt I had a high degree of safety, so I went ahead and took that trade. And then here's another one right at about 10%. So you can see most of these are 10%. Overall, my premium that I collected for the week, using this example, was $321.50 on a $2,900 investment, giving me 11% return in 1 week. Not bad for a small account. All right, so let's take a look at what's coming up this next week. Here are companies that are reporting next week. This is last week. These are some of the ideas that we looked at. These are all different companies. And what I say last week, this is what's coming up this next week, but we're not trading these because I can't get out of the options because I don't have, for example, if I go over here and I'm looking at Bank of New York or Citigroup, if I enter one of these trades, I can't really do it because I have Friday expiration to work with. Implied volatility is going to be high depending on what earnings do. I could have volatility crush, all sorts of things. So I can't really trade any of these that are coming up. So really what I'm doing is I'm trading not next week's earnings release, but the week after, and I'm setting my expiration date to this coming Friday so that I'm out of it prior to earnings release. So these are the companies that are coming up. SectorSpiders.com earnings calendar. You see we got Domino's Pizza. We have some more financials, some energy companies it looks like. So my software went out and scanned the universe of all stocks that are reporting this week, as well as other stocks, and then came up with some recommendations. So let's take a look. This is what it's recommending for this week. Now, I will probably not take a position in GM. The premium on this one is really small. The stock's trading at $53, strike's 51, but I'm only going to get 12 cents. I can't make enough to make that worthwhile and tie up $1,000 worth of capital for $12. Just not enough return there. So that's that. I'm going to automatically in my head rule some of those out. So where I'm probably interested in is looking down on the list, GEV. Probably take a position in that one depending on what it looks like on Monday morning. PayPal, we heard some news on PayPal this week where JP Morgan's making it a little bit harder to get some of the data. They're going to have to pay for it. So that's probably why implied volatility shot up. And then look at Robinhood. Now, I'm going to make a decision Monday morning what I decide to do. But at this point over the weekend, this is what it's looking like. Look at Robinhood over here. If I were to enter this as a naked put and sell a 91 strike, it's currently at 98.34. 91 strike, I'm going to get $73. Again, I may give up some of that premium to buy like a 91 and then go down and buy it. I mean, sell a 91 and then go down and maybe buy an 86. Depending on what that's selling for, I may give up some of this premium and but cap my risk in case Robinhood tanks. I don't expect it to tank, but look, it's got earnings July 30th, and a lot of times this strategy actually works pretty well because a lot of times companies don't move before earnings and implied volatility is very high, which means I can go further out of the money for my puts and collect some of that premium. If I'm right and it stays north of $91 by Friday, I will make 4% doing a naked. Now we'll see what it looks like at the end of next week. But these are some of the ones I'm looking at. Probably PayPal, yeah, 2.65% return. 2.65% return, I'll probably take that. 2.11, the software is assuming I'm selling these as naked puts, so I would be taking all the downside risk if these stocks are put to me. Also a $68 strike price. If it goes below that, well, I keep the 36 premium, but then I'm taking the risk anything below that. Again, I may cap this with a 68 and I might go down to 65 or 64 and buy insurance down there so that if it sinks further. And what I'm talking about is this. So let's say this is PayPal. Instead of using these prices here in the payoff diagram that I shared with you before, let's say this is the 68 in our example, and we're collecting 36 cents from before. So that's $36. So rather than carry it all the way down, what we're going to do is we're going to go down here and we're going to buy a strike. Say this is a $65 strike instead of this example that I shared before. This is selling for somewhere around, let's see, it's selling for 12 cents. So I'm going to collect 36, but I'm going to buy this one to protect anything below 65, and I'm going to collect 12 cents for that. So essentially, my profit then becomes $24 as long as it stays north of 68 strike. All right, so let's jump in to our implied volatility. First, let's look at PayPal since that's what we're talking about. PayPal. Look at the implied volatility on this. So here's historical volatility. Implied volatility is shooting up most likely because of earnings and the news release that came out on Friday. So that's making premiums a little bit more juicy. All right, let's see what it's doing in terms of our chart. There's the big news event. Look at that. You can see it very clearly what happened on Friday. Chase came out and said you're going to have to pay for some stuff that you've been getting for free, so it's going to affect margins, which may mean that Monday morning this actually opens up a lot lower. So given that, the software is recommending a $68 strike that actually works pretty well because that's right at the support level. But depending on where it opens up, I may actually go down a little bit lower, and then I'll report on that next week. Looking at that, let's go over to our Thinkorswim. Let's look at Thinkorswim. Here's the trade setup. So there's the $36 it's recommending, the $68 strike. I can sell that, go down to 65, buy that one there. There's the profit diagram that we looked at a second ago. I'm going to collect $24. I'm actually risking $280. Okay, let's go back to GEV because that was the other option. So that's selling for $539. It's recommending a 510 strike. So going back to Thinkorswim, let's go look at GEV, and it's recommending a 510. So there we are, $215. Let's see what happens if I go down to, instead of doing 5 below, let's do 10 below. That way I can get the 215 and I'm only paying $1.40, somewhere around that range. I'm going to risk $1,000 now. And so I'm 1,000 minus my 105 credit. I'm actually only risking $8.95. So there's my trade. I get $1.05. So $1.05 on an $895 investment. That's over 10%. So I'll probably take that one. And then the other one it recommended was Robinhood. Let's see where we look on Robinhood. So Robinhood, 73.91. So let's go. It's selling for 98.34. 91 strike. And I'm going to go out to Friday. Let's go sell that 91 strike that it's recommending. So I'm going to get somewhere between 73 and 76 cents. All right, let's go down and do another buy on a put spread here. Let's go just 5 below. So we'll make it 86. And let's see what this one looks like. All right, so $48 on a $452 investment. Another one that's a little over 10%. as long as it stays above 91 bucks. And given that it's a 98.34, there's a good chance of that happening. Now, let me show you something here that I think is super important. Right here, when the market opens, see this $6.87? A 73% implied volatility, which means by Friday, they're expected to move roughly $7 up or down. What I can do, and that's where I'm getting that $91, it's moving to 71. I may, depending on how it opens, I may even go a little bit further below that. I may go down to $10 below. I might go open up 88. If I look at my probabilities, it's a 10% chance of it being below 88 or 90% chance of being profitable. So that's what I'm looking at when I make this trade. I'm looking at this implied volatility. I'm making my decision on that because that's the expected move. And I want to be at least below the expected move, either at or below the expected move when I make my trade. That is how I'm setting that up. Let's take a look at Robinhood real quick. And 91 puts us at a support level. If you look at this spot right there, that is a support level right at 91. So I may actually go a little bit below that. I may put it further down, somewhere between 91 and 85, maybe 88, somewhere along in there. And my goal is that this stock literally just meanders here for the next few days, right? Okay, so that's it. I'll report back next week on the results. This is not financial advice. Do your own research, and happy trading. See you next week.